By meeting early before December 31st, it's not about, oh, how much am I going to be paying in taxes? It has nothing to do with that. It's how much can you deduct out of your business so you don't have to pay in taxes. That's the huge thing that I need these guys to start to wrap their head around. You can run a $500,000 to $1 million business and have a tax bill that's pretty darn close to zero.
Yes, and I think people are usually under two different strategies, whether they know it or not. So, there's all sorts of different rules on these things.
So that's a red flag. So that's an IRS red flag. Is that
right?
You don't
want to, yeah, because you want to treat it the right way, so you don't deduct all the payments. You depreciate it.
Deductions. Let's talk about what an actual deduction is first and foremost. So these guys know what an actual deduction is. Can you tell me what that is?
Sure.
Accounting is confusing, and it is a huge part of the overall success of your business. When I was first starting out in my company, I brought all of my records into my accountant, and he sat down and told me that I owed the IRS over $37,000. I didn't have that much money in my bank account. How can I owe the government more money than I actually physically own? I took my same records to another accountant that I'd never met before, but I got a high recommendation that this was a business accountant. When I turned those records over to him, I owed nothing to the IRS, and that's when a light bulb went off. Accounting, the rules are in black and white, but sometimes the way that you can interpret those rules and allocate different expenses has a massive impact on the overall success of your business. Today, guys, I don't want you to be an accountant by the time you're done with this video, but I want you to be able to talk to an accountant, vet an accountant, and have just enough basic knowledge so that you can be comfortable when you get your own numbers back from your accountant to know that you're in good hands. This is a two-part process. This is part of our While You Work series. And remember, guys, the overall success of this is you guys hitting the like button, hitting the share button, and commenting anything down below. I don't care what you say. Say any comment you want. Get creative. Let's get into today's video and meet my accountant. Guys, this is Jeff Law. He's actually my accountant. And I've said it, I can't tell you how many times. You've got to establish an actual relationship with your accountant so that they know your business. H&R Block is one thing, but having an accountant that does things like Jeff does, call me up, bug me over and over, because you call me, Shane calls me, and you say, hey Stan, we need you to come in before this date, because we get busy as contractors and we lose track of time. But in reality, you are 33%, and that's what I say, of the actual success of the equation of any small business. I don't care if you're a contractor, I don't care if you own a restaurant. Small businesses have to pay X amount of money to the government every single year. And what we want to talk about today is some strategies that contractors and any small business owner can use that gets them ahead of the curve.
Sounds good, Stan.
Okay, so this is November. One of the very first things, one of the things that we've got to do, that every contractor, every small business owner should do, is pre-tax season planning. And that means tax season planning before the fiscal year ends, which is typically December 31st. Is that always December 31st, Jeff?
Unless you elect out to a fiscal year, it will be December 31st, and that's how most people operate. So yes, a couple months before the end of your fiscal year, usually the calendar year, you don't want to wait any longer. Otherwise, once you do your planning and see where you're at, it's too late to do anything to change it then at that point. So that's why we try to meet in November, so you have a good month plus, buy equipment, or at least know where you're at. Even if you're not going to do anything, you kind of know what to expect then for if we need to make payments in January and or in April, what you're kind of looking at. So
by meeting early before December 31st, it's not about, oh, how much am I going to be paying in taxes? It has nothing to do with that. It's how much can you deduct out of your business so you don't have to pay in taxes. That's the huge thing that I need these guys to start to wrap their head around, because when you do it the right way, you can run a $500,000 to $1 million business and have a tax bill that's pretty darn close to zero.
Yes, and I think people are usually under two different strategies, whether they know it or not, profit or growth. if you want to follow growth strategy, you can build a business to $500 to $1 million without paying much tax because of the tax laws and being able to deduct, equipment when you purchase equipment for 50,000 or whatever the amount is. Being able to deduct all of it that year, if your profit was 50,000, now you've paid no tax if you buy that. There's some different rules for states, which we won't worry about, but on the federal level with the accelerated first year depreciation, you can eliminate quite a bit of profit for the small guys. And the amount too went up to $1 million, which for small businesses, I don't have people that are maximizing that, but so there's plenty of room for the small guy to eliminate their profit. Now the catch-22, which is you have to have the money to do that or the financing to do that, to purchase the equipment.
Oh, exactly. So one of the things that we're talking about is the difference between being proactive and being reactive. And obviously we need to be as proactive as possible. And that means, like right now, I feel like I'm almost being reactive because it's getting close. It's November 21st.
Sure.
And I should have actually been in here with you in October, the end of October at the latest, which gives me then 2 months. I can project my income ahead.
Yep.
I can use everything that I've done up to the end of or the beginning of November, project my income ahead, and then figure out where my profits are going to be, and then how much equipment that I need to buy to actually reinvest into myself. Because every penny that I'm reinvesting into myself, if I'm doing it the right way, is tax deductible. And I want to talk about what is tax deductible, what is not tax deductible, and so that these guys can start to understand that. But when I'm reinvesting into myself, literally the checks that I would be writing to the IRS, I'm now just putting back into my own company, which is that's a huge part of the financial planning for any small business owner.
Correct.
So the rule of thumb I'm going to say is make sure that you get into your accountant months ahead of time, at the latest weeks ahead of time, and then you're going to be scrambling because if you're running an okay business, you're going to have money to spend. And we've spent a lot of money over the last 10, 20 years just to avoid tax bills, and that's how we buy all new equipment every single year.
Correct.
And so there's leasing equipment, there's buying equipment, there's different loopholes and advantages, and so let's talk about some of that stuff. Can you want to take that over a little bit?
Sure. So if you lease, and there are some different rules, and that's why you do need to work with somebody. You're not going to be able to do all the research and stay up on everything when you're building a business and working long hours. It's just like I wouldn't try to build my own deck or anything. You have to have people that do those things for you. But back to your question, if you lease something and it's for 100% business item, which I'll assume everything we're talking about is items that are going to be used 100% for the business.
Yep.
So all of your lease payments would be deductible then.
Would be 100% deductible.
Correct.
Right?
For that equipment. Correct. Okay. Now you wouldn't own that equipment. You give that back then at the end of that 5-year lease or whatever the terms of your lease are. So one of the different rules I would mention that some people get confused on, and that's why important to have a professional. If you have a lease with like a $1 purchase at the end, IRS considers that a purchase up front. Then that's not a lease. So then you depreciate it, because who doesn't take it for $1 at the end of the lease? They consider that a purchase then. So there's all sorts of different rules on these things.
So that's a red flag. So that's an IRS red flag. Is that right?
You don't want to, yeah, because you want to treat it the right way. So you don't deduct all the payments, you depreciate it, and then otherwise, if it's a legitimate lease option with a fair market value buy at the end, you deduct all your lease payments along the way, and then you purchase it for X amount, and then depreciate that item. But when it's a bargain basement price, like $1, then that's just considered a purchase up front.
Okay, and I want these guys, I really want us to break this down in the absolute simplest terms possible, because
Sure.
I don't want to lose any one of these guys along the way. So a lease, let's say a business makes $100,000 that year. That's just their gross, right? And they're like, I need to lease a truck.
Okay.
And that truck lease is 25 grand. Let's just say 25 grand.
Yep.
So they're not buying the truck. They literally wrote $25,000 out to their local Chevy company for
Sure.
the lease. That means they take the 25 grand away from the 100 grand that they made on the year,
Correct.
and they have $75,000 of income left, and that's what they would then potentially get taxed on.
Correct, before personal deductions and other items, correct.
Right. I just want to break this down
Yep.
into very simple terms because there's so much confusion over everything related to taxes. Plain and simple. And
Yep.
so what our goal today is to help clear some of that up. We're not going to answer everybody's questions, but I want these guys to have a path so that when they talk to their accountant, because I interviewed you, and this is one of the things that you guys need to understand. I actually interviewed your dad. I sat here with him, and as a business owner, I was determining who I was going to work with, and he answered questions. So you guys be picky, because this is the dude. Your accountant is the dude that is a huge part of your financial success.
Yep.
Because when it comes to taxes, when it comes to accounting, the rules are in black and white, but the interpretation of those rules are in gray. And that may sound iffy, but here's the thing. Tim did not use you. Tim's my manager. He did not use you. He went to a different accountant, and he's like, I gotta spend $3 grand paying taxes this year, and I don't have it. I remember this conversation I had with him 10 years ago. And I says, who are you using? And he was using H&R Block or somebody. I don't remember, but you remember this, right?
Not completely, but I know who you're speaking of.
And so then I'm like, use my accountant. And so then he came to, was it your dad or you? I don't
My
remember.
dad at first.
Yeah, it was your dad. And your dad did the same taxes, and Tim didn't owe anything. H&R Block guy said he owed $3 grand. Your dad recalculated all the numbers, ran them. He didn't owe anything. Now, if Tim had stayed with that same accountant originally, 10 years later, Tim would have spent an extra $30,000 in taxes that he didn't have to, but because he went to an accountant that understood his business, understood his personal situation, understood where he was at, he was able to maximize the deductions, minimize the amount of money that he had to spend in, and that's $30,000 that went into his pocket that he's reinvesting into his business instead of writing a check over to the IRS. And when I say the rules are in black and white, but the interpretation is in gray, if anything was going wrong, the IRS would have said years and years ago, hey, this isn't right, and you owe us this money. But you can see where two accountants can give you two completely different results using the same set of numbers. And it's how they understand your business, which is the most important thing.
Yeah, and that's asking questions. And I don't want to say that somebody can't do your return right if they never ask you questions, but that doesn't work for me. People that if you come in and meet with me face to face, or if you send me your information, we're going to have email exchanges and or phone call, because I'll have questions. We always find things that they just haven't sent in. So your accountant should understand your business, but there's going to be transactions in your bank. I'm going to have to say, hey Stan, what was this one for? And it's just, so if they're not asking you questions, to me that would be the biggest red flag, because you're not going to send 100% perfect information to me. I'm gonna have to ask questions, and so if they don't, I'd be worried that stuff was being missed.
Let's talk about deductions. Let's talk about what an actual deduction is first and foremost. So these guys know what an actual deduction is. Can you tell me what that is?
Sure. I mean, the definition for a business expense is it has to be ordinary and necessary. So necessary if you need it for your business. And again, you mentioned kind of interpretation. There is a little bit of interpretation, but and common sense really. If you're traveling to a out-of-state convention for landscaping, contracting, whatever, you go for 3 days, that's what you did, that's all deductible. If you go to same location for a week and you're timeshare and you duck out for a 3-hour contractor meeting, that trip's not deductible. That was a personal trip that you just went to a seminar on, and you can deduct it if you paid anything for that seminar. But there's just a lot of different scope of things, and then looking at your office, using your home office, mileage, different deductions for vehicles. But I'm going beyond the scope of your question. So
No,
it has to be
you're just answering my
necessary.
next question.
It has to be necessary for business, which is why I use the travel example. I mean, is a convention necessary for business or ordinary? I would say yes and yes. That's reasonable, right?
Right.
But is it necessary for you to spend a week out there and go skiing and go to a convention? I mean, you just have to use some common sense. And it's kind of the difference between tax planning, which is completely 100% legal, and tax avoidance or evasion, which you've heard those terms. That's not what we do. We do tax planning to legally figure out ways to lower your tax. Tax evading is, you don't report your income or take that trip to Colorado that wasn't really business. That's tax evasion. Tax planning is coming in and, my profit is this. Do I need any equipment? Or, if you buy this excavator you need for 60 grand, that's going to take 60 grand off that 100,000 before, and now we've got 40,000 that we're working with before we get to your other personal stuff.
So let's play through a scenario of different deductions and how it can actually impact your income.
Sure.
So you are a small business owner. Your business brought in $100,000 in the year.
Yep.
You bought the truck for 25 grand.
Yep.
You leased it. You didn't buy it. You leased the truck, so you can deduct 100% of that lease, right?
Correct.
And that's your work truck.
Yes. We're assuming this is 100% a work vehicle.
100% of the fuel that goes into that work truck is tax deductible.
Correct.
100%. That
if it's
means
100% business vehicle, 100% fuel, insurance, repairs and maintenance, tabs.
So
the only thing you can't take is mileage. That's the difference. It's mileage or actual expenses, which actual would be your lease payments, or if you buy it, depreciation is how you recapture the principal amount.
So you're a small business owner, let's say you put 10 grand into fuel insurance, etc. You can deduct it because this is your dedicated work truck. So now you've got 35,000 in expense.
Correct.
Okay. But you are a contractor and you need tools to complete a job. So you go out and you buy yourself shovels, you buy yourself rakes, you buy yourself all of these tools that you need for your business.
Correct.
You spend another 15 grand on investing into equipment.
Okay.
All right. So where are we at right now?
50 grand, I believe.
Well, let's just say we've total with the truck, fuel, insurance, extra tools. You've invested 50 grand into your business. Okay. So now you've taken your $100,000, which the average person would pay taxes on $100,000 if it was just they were an employee.
If it's a W-2 job, you pay on the top amount. I mean, there are some things, 401s and different things people can do to lower the taxable portion, but generally, yes. 100,000 of contractor income, then you take expenses. If you're working as a W-2 employee, 100,000 before you're paying on 100,000 because you can't deduct any personal expenses or work expenses of the W-2 employee.
Okay, so let's make sure that we're absolutely straight on this. As a small business owner, you have $100,000, you bought a truck, all this stuff, equipment, and you literally cut your taxable portion in half. As an employee, if you made $100,000, you pay taxes on the full $100,000. Am I right or wrong?
Correct. I guess we're just assuming that your company isn't giving you any reimbursements for the vehicle. But if they were not, then that would be correct.
Okay. So this is one of the few advantages that business owners have, is because they can deduct things like, let's talk about things that the gray area deductions. Let's just be very frank, very open. What about a garage? Because a lot of these guys, while they're in the growth stage, they're storing their stuff at their home, in their garage, in their, how would that break down?
That's awesome you brought that up, because...
So let's talk about purchasing equipment, what is tax deductible, what is not. Because there's guys that may go out and buy themselves a vehicle and they may sign on the dotted line, but not buy the right vehicle and not be able to take the deduction. Right. So these guys, we've got to pound this in. This is what you need.
I may be forgetting something.
Let's talk about a few of the IRS red flags that guys need to avoid. Common mistakes that guys may think they're okay on, but it's going to be a big in the IRS office. Hey, let's audit this guy. Sure. Because I was that guy. One of the hardest lessons that I ever learned was with the IRS, with taxes, with understanding. I mean, I made every single mistake that a small business owner could make, and I survived by the skin of my teeth. And so I don't want guys out there doing what I did, because I shouldn't have survived. I want you guys to thrive and not just get by. So you guys tell me, does a video like this actually help you? I know it's not the most entertaining, it's not the most exciting, but when it boils right down to it, to me, it's probably one of the most important things that you guys can do. Tell me what you guys think in the comments down below, and we will see you guys in part 2. I'm going to pop a video here, and please hit the like button. Please share the video, and we will catch you guys next time. God bless, and go get them, you guys.